Good afternoon, ladies and gentlemen. Let me welcome each one of you to this press conference. With me on the dais are Mr. Atanu Chakrabarti, who is the chairman of HDFC Bank, Mr. Shashi Jagdishan, the CEO of HDFC Bank, and my colleague Keki Mistry, Vice Chairman and CEO of HDFC Limited. I was a little disappointed at the press intelligence that no members of the press could decipher this, because it's always you are one day ahead. Tomorrow's news you are supposed to give today. And I was disappointed that you failed this time. But we tried our best. The work was going on for the last 3 weeks, and we tried our best to keep the number of people involved limited and strict no talking. Anyway, the Board of Directors of HDFC Limited and the Board of Directors of HDFC Bank, at their respective meetings held today, have approved an all-stock amalgamation of HDFC with HDFC Bank. The amalgamation is subject to the approval of shareholders of HDFC and HDFC Bank respectively. RBI, stock exchanges, SEBI and such other regulatory approvals as may be required for approving this merger. Only upon obtaining all approvals when the merger will become effective. HDFC will merge with HDFC Bank. Shareholders of HDFC will receive shares of HDFC Bank in exchange of the share in HDFC at the approved share exchange ratio. Bansi Mehta and Company and Deloitte Touche, appointed by HDFC and Bank respectively, have recommended a share exchange ratio which has been accepted by the respective boards. Bank of America, Merrill Lynch Securities and Morgan Stanley provided the fairness opinion on the share exchange ratio both to HDFC and HDFC Bank respectively. Accordingly, shareholders of HDFC Limited will receive 42 shares of the bank for 25 shares held in HDFC Limited. The shares held by HDFC Limited in the bank will be cancelled. Post-closing, HDFC Bank will be 100% owned by public shareholders, and existing shareholders of HDFC Limited will own about 40% of the bank. So there won't be any promoter left in the HDFC Bank. It will be all in the market. As today HDFC has no promoters and the entire shareholding is listed in the market and can be traded. Similarly, HDFC Bank now, earlier we had 21% of the shares, now it will all be in the market. Both of us have been evaluating the pros and cons of a possible merger for mutual benefit of both institutions. The merger is coming together of equals. Customers of both HDFC and the bank will be the biggest beneficiaries. However, over the last few years, there have been certain regulatory changes for banks and NBFCs, which have considerably reduced the barriers for a potential merger. The last 3 years has seen a host of guidelines issued by RBI on harmonizing the regulation between banks and NBFCs. These have included guidelines such as large NBFCs should be converted into commercial banks, particularly those over 50,000 crore asset base. NPA classification, which was different before, Reserve Bank has now made the same NPA classification for NBFCs, housing finance and banks. The Reserve Bank has now we are required under the Reserve Bank regulation to provide liquidity coverage ratio. That means NBFCs need to maintain liquidity against the next 30 days outflow on a rolling basis. Scale-based regulation for NBFCs have been introduced by RBI, where we would be recognized as a large organization in the upper layer of NBFCs. And the upper layer of NBFCs will have a much closer and stricter regulatory requirement. Another factor is core financial solution system. RBI has asked the NBFCs to follow a core financial solutions like the bank, which is following core banking system, and risk-based internal audit. These measures have considerably reduced the regulatory arbitrage which was there between a bank and an NBFC. The strategic rationale for the proposed merger is as follows. The reduced gap in liquidity requirements between a bank and an NBFC. The SLR and CRR for banks was 27%, which has now been reduced to 22%, 18% for SLR and 4% for CRR. Interest rates are more favorable today as compared to earlier years. Banks have an option to invest in priority sector lending certificates to meet the PSL requirements as against direct lending to agriculture and MSME as in the past. With RERA and IBC, real estate is seeing an increased level of transparency, and mortgage customers can have access to a range of financial products under one roof now. Change is inevitable, but change is beneficial. Change is welcome when it is beneficial to all the stakeholders. So the merger makes the combined entity strong enough not only to counter competition, but make the mortgage offering even more competitive. We will be able to offer all the variations in the mortgage product, which currently as HDFC standalone we are unable to offer, such as an overdraft product. The funding challenges both in quantum and cost will be minimized by the combined entity. The merger will therefore capitalize on our domain knowledge in real estate and mortgages, as well as our operational efficiencies in processing mortgages, whilst leveraging the cost of funds efficiency and the wide distribution network of the bank. So the transaction involves the amalgamation of HDFC and two of its wholly owned subsidiaries, HDFC Holdings and HDFC Investments, with HDFC Bank. HDFC Limited is the promoter of HDFC Bank, and together with its two subsidiaries currently holds 21% of the share capital of the bank. Post completion of the merger, all the subsidiaries and associate companies of HDFC Limited will be owned by HDFC Bank, subject to regulatory approvals. As on April 1, 2022, the market capitalization of the bank was 8.36 lakh crores, which is 110 billion, and HDFC was 4.46 lakh crores, which is 59 billion. Asset size of the bank today is 18.4 lakh crores, and on a consolidated basis, HDFC is 8.8 lakh crores. Bank has 6,300 banking outlets and 17,000 ATMs. HDFC has 651 offices, inclusive of 206 outlets of HDFC sales. The bank has requested Reserve Bank for phased-in approach in respect of SLR and CRR, priority sector lending, as well as grandfathering of certain assets and liabilities, and in respect of some of its subsidiaries. These requests are under consideration by RBI in terms of their letter to the bank dated 1st April 2022. In the past, the merger would not have been as value accretive as present. The merger will lead to significant synergies of combined entity and a better return to shareholders. The combined strength of the balance sheet of the combined entity will be the ability to compete on not only on the funding side and the ability to offer the entire range of mortgage products, which is a win-win situation for both institutions. As a bank does not do loan origination, they originate and we distribute, we appraise, and they. So this will be a new product. It's an addition of a bank activity. So the benefits are lower cost of funds will be made available for mortgage business.